Here is the transcript cleaned up to remove timestamps and smooth out minor speech stumbles while preserving all original text, meaning, and structure. Right now, the credit card sitting in your wallet, the one you used this morning for coffee, gas, or groceries, is operating under rules that quietly changed, and most people have no idea. Three regulatory shifts are moving through the credit card industry at this exact moment. Two of them are already affecting your account. The third one is the one nobody is talking about. And by the end of this video, you'll know all three, including the last one, which almost nobody believes could actually work in their favor. It does. Hey, I am Lana Maines. On this channel, I break down the kind of financial information that usually only shows up after it's already cost someone money, the stuff your bank isn't going to call and walk you through. If that's the kind of information you want in your corner, go ahead and subscribe, because that's exactly what this channel is built around. Your credit card relationship isn't a handshake agreement. It's a binding contract governed by the Truth in Lending Act codified at Title 15, United States Code, Section 1601. That matters because your issuer has the legal right to change almost any term of your account, your interest rate, your fee structure, your grace period, with 45 days advanced written notice. And here's the part that costs people. That notice does not have to look urgent. It can come in the same envelope as your monthly statement. It can be a small insert printed in gray ink on a half sheet of paper. It's legal, it's routine, and it's how billions of dollars transfer every year from cardholders who don't read their mail to issuers who count on exactly that. There's no penalty for missing the insert. There's no alert on your phone saying your terms changed. There's just money leaving your account every month that never had to. So, by the end of this, you'll know which three changes matter, who each one hits hardest, and the 6 checks you can make on your own accounts. And stay with me through rule number 3. That's the one with the biggest hidden upside, but it also carries a downside that can spread into cards you've held for years. Rule number 1, the $8 late fee cap that isn't protecting you yet. Rule number 1, this was supposed to be the clean win for cardholders. The mistake is assuming that because you've heard about the rule, it must already be protecting you. It isn't. The Consumer Financial Protection Bureau proposed a rule in early 2024 that would cap credit card late fees at $8. The current industry average for a late fee runs between $30 and $41 depending on your issuer. Capital One, Citibank, and Bank of America all sit in that range for a first-time missed payment. The CFPB designed the cap to stop what the agency called excessive penalty fees that disproportionately burden lower-income cardholders, drawing its legal authority from the Credit Card Accountability, Responsibility, and Disclosure Act of 2009, specifically the provisions at Title 15, United States Code Section 1665D. For a lower-income cardholder, the benefit is obvious. A $30 late fee on a $200 minimum payment is effectively a 15% penalty for being 5 days late. For a retiree on a fixed income, that can start a cascade, a higher balance, a higher minimum next month than another missed payment. An $8 cap breaks that cycle earlier. For the comfortable middle-class cardholder, the benefit is less visible. Even someone who's never paid a late fee benefits indirectly because a lower industry-wide cap was projected to reduce pricing pressure. Less fee revenue means, in theory, more competitive interest rates. But here's the pass or fail test. Open your account today and look at the late fee line. If you still see $30 to $41, that's because the $8 cap is not in force at your bank right now. Why not? The rule ran into a federal lawsuit filed by the U.S. Chamber of Commerce in the Northern District of Texas. As of today, that rule sits in legal limbo. It has not taken effect. The court issued a preliminary injunction blocking implementation while litigation proceeds. So, the $8 cap you may have heard about is not protecting you today. Your issuer is still legally charging the full $30 to $41. Major issuers didn't wait for the court to settle it. They started adjusting their models in anticipation. Chase, Citibank, and others quietly began tightening grace periods, the window between your billing cycle closing and your payment due date during which no interest accrues. Some shortened that window, others tightened credit limit increase criteria, and others scaled back perks on mid-tier cards. Not with a press release, but with a half-sheet insert tucked inside a statement envelope. The expensive option is doing nothing because you assume a long history with the same card protects you. It doesn't. The cheaper move is reading the terms that govern the account. Take Patricia. She's 63, a retired hospital administrator in Phoenix, Arizona, and she's held the same Visa card since 2009. Patricia has never paid a late fee. She's always paid her balance in full. Last October, she noticed her interest rate had jumped by 2 percentage points. No phone call, no negative credit event, and a credit score of 791. What Patricia missed was a rate change notice sent 11 weeks earlier as a single insert inside her October statement. She did nothing wrong. She's exactly the cardholder every issuer claims to value. Yet she was repriced without a direct explanation because the law allows it with that 45-day written notice. That's rule number 1 in the real world. Not the rule as written, but the rule as anticipated by issuers who moved before the court reached a final decision. How to check. If your own terms already changed. Check it yourself. Open your issuer's app or website and go to Account Terms, not the statement or card agreement. Find the grace period and write down the exact number of days. Then find the late payment fee and write down the exact amount. If those numbers have shifted from what you originally agreed to, your issuer already notified you in writing at some point in the last 12 months under Title 15, United States Code Section 1637. You may not have read it, but it was still sent. Now, rule number 2 flips the problem. Rule number 1 is about fees, timing, and terms. Rule number 2 can hit the cardholder who does everything right, pays on time, and assumes rewards are the safest part of the deal. Rule number 2, the Credit Card Competition Act and your rewards. Rule number 2, the Credit Card Competition Act has been reintroduced in the current congressional session with bipartisan sponsorship. It would amend the Electronic Fund Transfer Act to require that any credit card issued by a bank with more than $100 billion in assets, Chase, Bank of America, Citigroup, Wells Fargo, Capital One, and a handful of others, enable at least 2 unaffiliated card networks on every card. Right now, a Visa card only routes through Visa, and a MasterCard only routes through MasterCard. This legislation would force those cards to support a competing network too, letting merchants pick the cheaper option at checkout. The insider term here is interchange fee. That's simply the cut taken before the merchant receives the full value of your card payment. When you swipe at a grocery store, the store doesn't collect the full payment. The card network and issuing bank take a cut first, typically 1.5% to 3.5%. On a $100 grocery run, that's $1.50 to $3.50 going to the network and bank before the merchant sees a penny. Nationally, interchange fees add up to roughly $100 billion a year, moving from merchants to card networks and issuing banks. For the lower-income cardholder, the argument in favor is simple. Lower interchange fees can be passed on as lower prices. A grocery store paying 2.2% in card fees has an incentive to cut prices if those fees drop. That's the sponsor's case. But here's the honesty this debate needs. For the comfortable middle-class cardholder carrying a rewards card, there isn't really a win. Your cashback, airline miles, and hotel points are funded directly by interchange fees. A premium rewards card charges the merchant a higher interchange rate, and a slice comes back to you as points. That's the economic model behind premium rewards cards. So, don't assume rewards are permanent. They aren't. They're funded by a revenue stream. Change the stream, and the rewards model changes. If the Credit Card Competition Act passes and interchange rates compress the way debit card rates did after the Durbin Amendment, debit interchange revenue dropped by roughly 50%, the model funding your rewards collapses with it. Delta, Chase, and American Express have each told Congress directly in formal testimony that interchange compression would materially reduce their ability to fund rewards programs. That's not marketing language. That's a description of how the revenue actually works, and this isn't a bill that failed and disappeared. It keeps coming back. Both the Senate and House versions have picked up additional co-sponsors across successive sessions. The debit card precedent under Durbin was tucked into a larger bill as an amendment with almost no public attention. The same thing could happen here. So here's your sensory check on rule number 2. pull up the actual rewards terms, not the glossy card page. Look at the earning rate beside groceries, gas, travel, or whatever category matters most to you. If that number moves, you'll see the effect before any commercial tells you what changed. Take Gerald. He's 71, a retired high school principal in Baton Rouge, Louisiana, and he's carried a cashback Visa card for 14 years. He earns roughly $1,100 a year in cash, back on ordinary household spending, groceries, utilities, prescriptions, gas. He doesn't think of it as a financial strategy. He thinks of it as the card doing its job. If the Credit Card Competition Act passes in anything close to its current form, that $1,100 could shrink to $400. Gerald did nothing wrong. He built a responsible habit around a financial product the law may be about to restructure, and nobody has mailed him a single word about it. Co-branded store cards and small business cards aren't automatically exempt just because they feel different from a bank-issued Visa. If your card is issued by one of the larger banks under the asset threshold, the same routing requirement would likely apply whether the card has an airline logo on it or a big box retailer's name. If you carry more than one rewards card, check which bank actually issues each one. The asset size of the issuing bank, not the brand on the card, is what determines whether this rule reaches your account. So here's what I want you to do. The exemptions, the breaks, the refunds most seniors already qualify for but never claim, I've put them all in one place, state by state, form by form, so you don't waste hours digging through government sites. Everything's laid out fast and simple, so any senior can find exactly what applies to them. No matter what state you're in, there's money you're leaving on the table. It's called the Senior Exemption Playbook. It's in the first pinned comment right below this video. Just tap it once and you'll have everything you need. Now, stay right here because the last rule is the one with the biggest hidden upside most cardholders never claim, and it's the reason I made this whole video. Rule number 3, BNPL is now regulated, like a credit card rule. Number 3, the Consumer Financial Protection Bureau has formally classified buy now, pay later services, Affirm, Klarna, Afterpay, Zip, and similar platforms under the same regulatory framework that governs credit cards. The interpretive rule was issued in May 2024 under the Truth in Lending Act, specifically the Regulation Z definition of credit card implementing Title 15, United States Code Section 1602. Under this classification, BNPL providers now owe users the same protections that apply to traditional credit cards: the right to dispute charges, mandatory refund rights when a merchant processes a return, and billing statement requirements. At the same time, Experian, Equifax, and TransUnion have been building frameworks to bring BNPL payment data into credit files. Experian began accepting BNPL trade line data in 2022. Equifax and TransUnion followed with pilot programs. Whether your BNPL account shows up on your credit report right now depends on which provider you used and whether that provider has started reporting. Affirm reports to Experian on select loan types, and Klarna has run its own U.S. credit reporting pilot. Don't overstate this. Not every BNPL account is on every credit report today, but the direction is one way. BNPL data is moving onto credit reports. The question is which accounts and when. If you've used BNPL responsibly, paid on time, and paid in full, and that data starts appearing on your report, your credit score can actually improve. For consumers with a thin credit file, meaning fewer than 5 traditional trade lines, BNPL reporting can add meaningful positive payment history. A FICO score sitting at 620 on the back of 2 credit cards and an auto loan could climb to 660 or higher with consistent positive BNPL history layered in, which unlocks lower rates on everything from mortgages to auto loans. For the comfortable cardholder using BNPL occasionally for an appliance, travel booking, or home repair, treating installments like credit card payments adds positive history across more trade lines. More positive trade lines paid on time means more score stability, which also protects existing rewards card relationships. Rule number 1 closes the loop here. Think back to who the late fee cap actually helps most. It's BNPL users, not traditional cardholders. And here's why. A BNPL installment plan is structured as a series of scheduled payments. Under the CFPB's new classification, late fees on those plans fall under the same regulatory framework as credit card late fees. If the $8 cap eventually survives the litigation, it applies to BNPL late fees as well. A BNPL late fee today can run anywhere from $7 to $30, depending on the platform. On $450 installments toward a $200 purchase, a $30 late fee on one missed installment is a 15% penalty on that single payment. When the cap eventually takes effect, it protects BNPL users more directly than traditional cardholders who already have more tools available to avoid fees in the first place. A BNPL payment that used to carry zero credit reporting consequence. It didn't help you, but it didn't hurt you either. Now carries one. A missed Affirm payment or an unpaid Klarna installment can now land as a derogatory mark on your Experian file, and that mark interacts with your traditional card accounts. A 40-point score drop doesn't just affect your BNPL relationship. It can trigger an automatic review of your entire credit profile. Capital One, Bank of America, and Chase all run automated systems that periodically re-examine existing accounts. And a significant score drop can result in a credit limit cut on a card you've held for a decade without a single late payment. That limit cut raises your credit utilization ratio, which pushes your score down further. One missed $40 installment, now reportable, can cascade through your entire credit profile. That's the pass or fail test for rule number 3. Search your report. If the trade line is there, every payment needs to read correctly. Don't take anyone's word for it. Look at the file yourself. Balance transfer expiration dates, the silent rate reversion. And there's another clock running in the background that people often notice too late. Promotional balance transfer offers. A 0% APR balance transfer is a common way to pay down debt without interest piling on, and it runs on a fixed clock, 12 months, 18 months, sometimes 21. When it closes, the remaining balance reverts to the card's standard purchase, APR, which today often sits well above 20%. The expensive option is assuming you'll get a dramatic warning. Issuers aren't required to remind you before the switch beyond the same statement disclosures covered by the Truth in Lending Act, and a growing number of cardholders discover the reversion only after a higher interest charge appears on a statement. The right move is simpler. If you opened a balance transfer offer in the last year to 18 months, check the exact expiration date today, rather than assuming there will be a clear signal when it arrives. If you pay your statement balance in full every cycle, rule number 1 barely touches you directly, since late fees and grace period changes mostly affect people who occasionally miss a payment date or carry debt month to month. Rule number 2 hits you harder because your rewards depend on interchange revenue that has nothing to do with whether you carry a balance. Rule number 3 works in your favor almost automatically, since responsible, on-time BNPL use only helps a credit file. But if you regularly carry a balance, the order flips. Then rule number 1 matters enormously because a compressed late fee cap could reduce the cost of a missed payment. Rule number 2 matters less because interest already makes a smaller rewards rate secondary. Rule number 3 becomes the one to watch most closely because a missed BNPL installment can trigger a review of every other account you hold, including the one carrying your largest balance. Take Robert. He's 66, a retired warehouse supervisor in Tulsa, Oklahoma, who opened a balance transfer offer 11 months ago to consolidate 2 smaller card balances onto one card at 0%. He set a reminder for the day the offer expired, moved the remaining balance to a new 0% offer with a different issuer before the higher rate could apply, and paid roughly $400 less in interest over the year than he would have paying the standard rate on either original card. Robert didn't do anything unusual. He simply tracked a date that most cardholders never write down anywhere. One more wrinkle. Medical BNPL products used for dental work, veterinary bills, or elective procedures are being swept into the same reporting shift. A missed payment on a medical financing plan used to sit largely outside the traditional credit system. Increasingly, it won't. If you financed a medical or dental expense through a BNPL-style product in the last 2 years, check directly with that provider whether your account reports to a bureau. The answer may have changed since you signed up, even if nothing about your payment behavior has. Take Diane. She's 58, a retired logistics coordinator in Memphis, Tennessee. Diane used Klarna twice in the past year, once for new appliances after her dryer failed, and once for medical equipment insurance didn't cover. Both purchases were under $300, and both were paid on time. Diane had no idea those accounts might be reporting to a bureau at all. She had no idea that a single missed payment could have triggered a review of the Chase card she's carried since 2001. She did nothing wrong. She used the financing tool exactly as designed. The regulatory framework changed, and nobody sent her a plain English explanation. Authorized users. Eaters. Why the notice may never reach them. Adding a spouse, an adult child, or a parent as an authorized user on a card is a common way to help someone build or repair credit, since the primary account's payment history typically reports to the authorized user's file too. But that relationship runs in both directions. If the primary account gets repriced under Rule Number 1, rewards are restructured under Rule Number 2, or a BNPL-driven score drop triggers a risk-based review under Rule Number 3, every authorized user can feel the effects on their own credit file without being notified directly. Why? Because the notice requirement under the Truth in Lending Act runs to the primary cardholder, not to authorized users. So, if you've added someone as an authorized user, or if you are one yourself, confirm who actually receives account correspondence. It may not be everyone whose credit file depends on that account staying in good standing. A secured card backed by a cash deposit equal to your credit limit is often recommended as the safest way to build credit precisely because the issuer's downside risk is limited. That structure does reduce the odds of a sudden rate increase the way Patricia experienced, since there's less incentive for an issuer to reprice an account it's already fully collateralized against. But a secured card does not exempt you from the interchange economics behind Rule Number 2, and many secured cards already offer minimal or no rewards, so there's little room left to shrink. If you're using a secured card to build credit, Rule Number 1 and Rule Number 3 matter most, since Rule Number 2 was never really working in your favor. And one more layer, card issuers aren't only reacting to court cases and legislation. Some are already leaning on trended data models like FICO 10T, which look at your spending and payment patterns over time rather than a single snapshot. In plain language, the pattern matters, not just today's number. A model like that can flag a pattern of carrying higher balances even if every payment has technically been on time. That means two cardholders with identical scores today can be treated very differently by an issuer's internal risk system going forward. It's another reason the account terms you agreed to when you opened a card may already look nothing like the terms attached to it now. Your 6-step action checklist to protect every card you carry. Step 1. Verify your current card terms today. Search your issuer's name, plus account terms, plus the current year directly on the issuer's own website, not a third-party comparison site. Find the grace period, the late fee amount, and the current purchase interest rate, and write all three down with today's date. If any of those numbers differ from what you agreed to when you opened the account, check your statement inserts from the last 12 months. The change notification is in there. The wrong move is relying on memory. The right move is 3 written numbers with today's date. That's your baseline. Step 2. Set up automatic minimum payment on every card you carry. Not full balance autopay, minimum payment autopay. This is your insurance against a single missed due date turning into a fee and a potential credit consequence. It doesn't stop you from paying more than the minimum. It just prevents a missed date from becoming a fee, a mark, and a cascade. Small setting, big protection. Step 3. Audit your BNPL accounts. Search your email for confirmations or receipts from Affirm, Klarna, Afterpay, Zip, Sezzle, or PayPal Pay. Later over the last 24 months. For each one you find, check whether the account is active, whether a balance remains, and whether the platform's terms mention credit reporting. Then pull your full credit report from all three bureaus at annualcreditreport.com, the official site mandated under the Fair Credit Reporting Act, Title 15, United States Code, Section 1681J. If a BNPL trade line appears, confirm every payment shows as on time. If something looks wrong, you have the right to dispute it directly with the Bureau under Section 1681I. This is the measure it yourself step. Don't assume. Read the trade line. Step 4. Review your rewards card's current earning structure. Pull up the actual terms document on your issuer's website, not the marketing page, and confirm the earning rate on your top spending categories. If those rates changed in the last 6 months, a notice was sent. If you can't find it, call the number on the back of your card and ask them to confirm your current earning rates in writing. Then keep that record. The marketing page sells the card. The terms tell you what the card is doing. Step 5. Position across 2 card networks. If your wallet only has Visa network or only MasterCard network cards, add one from the other network, ideally through an issuer you already have a relationship with, rather than opening something new for the sake of it. If interchange legislation eventually passes and one network adjusts more aggressively than the other, you'll already have an alternative established in your credit profile instead of scrambling for one later. This isn't about collecting cards, it's about not having every option tied to one network. Step 6. Set a calendar reminder for 45 days from today to check your statement inserts specifically, not just the statement itself. The 45-day advance notice requirement under the Truth in Lending Act means any change your issuer wants to make in the next billing cycle was already mailed. Do that check today, then repeat it every 45 days going forward. And remember the pattern behind all 6 steps. Write down the terms, protect the due date, audit BNPL, verify rewards, keep 2 networks, check the inserts every 45 days. Tomorrow morning, when you use that same card for coffee, you'll know exactly which rules are operating in the background, which ones are still tied up in court, which ones are already reshaping the products in your wallet, and which steps put you ahead of the majority of cardholders who never open the insert in the envelope. One last thing worth carrying with you. None of these 3 rules require you to fight your issuer or prove a negative. The Fair Credit Billing Act already gives you the right to dispute a charge in writing within 60 days of a statement error. And the Fair Credit Reporting Act already gives you the right to dispute an incorrect mark on your credit file with the Bureau directly. Both rights existed long before any of these 3 changes started moving. What's different now is simply how many more moments there are across a late fee, a rewards rate, and a BNPL trade line where something can slip past you without a clear signal. Knowing where to look is most of the work. The people who protect their financial profile aren't the ones who never make mistakes. They're the ones who know which changes to look for before those changes cost them anything. You now know all 3. I am no licensed expert, so make sure to check all information with verified sources before you make any decisions.